You need to understand this. It's all about liquidity. Hi, everyone, and welcome to another week of Insights brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, we welcome back Joe Brombal to talk about a topic I'm very interested in personally, and one that I know Joe has been looking at in depth: the role of liquidity underpinning the moves we're seeing in pretty much everything right now. How are you going today, Joe?
Good, mate. Thanks for having us today. Great to be here.
I'm very glad to have you back on. We've been discussing over the last couple of weeks ourselves personally this concept of liquidity and what's going on and how that interplays with the market. So I'm very interested to get your perspectives sort of on camera here today, and I'm sure our audience will be as well. So thanks for taking the time. Let's dig straight into it. What is your take on the banking crisis? So we're all aware it's the headlines we're seeing everywhere at the moment. Banking crisis originating in the US, spreading across into Europe. We're seeing banks getting hit all over the place. We've discussed it a few times on Insights with different people. We sort of have that big picture idea of what it is or where it started to some degree. But do you see this as that we're coming to the end of that now? Is the panic over and we're now in the return to normal phase? Or is this just the beginning of something else? Where are we and where are we going from your perspective?
Yeah, so I think we're probably just starting. If you think about why this crisis is occurring, it basically comes down to people wanting to withdraw their deposits and put them either in a safer bank or into a money market fund, or they're buying short dated treasuries, and it makes complete sense why they would do that.
Mm-hmm.
You don't want to be the last guy out the door if it all falls over. So it's compounded by the age of information, where information spreads very quickly, whether it's true or not.
Yep.
And that's where we've seen the panic, and I think the outflows will continue, particularly from the little banks into the larger, bit too big to fail institutions.
And you would see it, I know from our discussions, you'd probably see it as it makes no logical sense to keep your money in those smaller banks
Absolutely
in
not.
this environment, does it? Because I know there's talk of blanket deposit guarantees so that you've got government effectively guaranteeing that if you put a deposit in any of the banks, they're safe. But it's more than that, isn't it? Because those smaller banks aren't profitable at these rates. So there's really no incentive at all to keep your money there other than sort of the hero trade, I suppose, to say, well, I'm supporting my local bank. Logically, it doesn't make any sense.
Yeah, that's it. That's all it would be, is the hero trade, to say that you're supporting your local bank. Otherwise, it logically, it makes absolutely no sense. So I don't know. I think it continues. It may have slowed at this point, but it's only slowed until the next bank fails and everyone starts remembering and starts to panic, and they start doing exactly what everyone else has been doing over the last couple of weeks.
So that gives us that sort of big picture overview of the initial spark that sort of started this bushfire effectively.
Yeah.
So what we have seen, and it was in the news today, was the chart of the Fed's balance sheet, which is related to what's going on here, right? So we've seen that chart go up basically 2/3 of QT or quantitative tightening that we've had over the past year. So all that hard work, 2/3 of that has been reversed in just 2 weeks. What does this mean?
Well, the Fed's raised rates too quickly, too fast in a short period of time. Like that's really what it means. And liquidity's been drained out of the system, and the reversal of the Fed's balance sheet is really the market screaming that they've gone too far. So we're looking at the Fed's balance sheet, whether it be the discount window of banks borrowing money, short-term rates to keep liquidity up. We talk about the BTFP program, where they're effectively swapping underwater bonds for cash,
Mm-hmm.
so they remain solvent. Or you could be, or it's the US swap lines with friendly neighbors. So, particularly on the swap lines, what the US are trying to do is they're effectively letting everyone know, hey, don't sell your treasuries that are underwater. Give us your treasuries, and we'll give you dollars, and everyone's happy. They don't want the treasuries being sold. They want the treasury market to remain stable. So I think that's probably why they're doing what they're doing.
Okay, so there's heaps of debate over whether that is just shuffling money around or whether it is quantitative easing. So I've had myself debates with a number of people over this idea who say, no, it's different. It's not actually putting new money into the system. And you just listed a whole range of different programs, right? Like you said,
Yep.
there's discount windows, there's reverse repo facility, there's money coming in through bank deposit insurance programs. There's all sorts of stuff going on.
Yeah.
Is it really all the same thing? Because that's my answer to those questions. I say it doesn't matter what they call it or what it is. At the end of the day, it's dollars coming into the system. Is that how you read it?
Well, if we look back to when QE started after the financial crisis, it was a panic. Like everyone thought it was money printing, and we saw that in the price of gold and silver, and everything just exploded higher. And then over time, people less as money printing and come to realize that it was more putting money into financial assets, not so much the mainstream. So I think that it's pretty hard to debate that that QE doesn't somehow find its way into financial markets. There was people have been debated it for 10 years until they finally accepted it at the end of probably the late teens, 2018, 2019, when they turned QE back on after starting QT for that couple of months when the market had a hissy fit. So
yep.
I think it's quite obvious that QE is effective in the form of propping up financial markets, producing liquidity, and effectively backstopping collateral from failing.
And that's a really important point. It's a little bit subtle, but it was mentioned in the article today, this idea of monetary inflation versus high street inflation. So,
yep.
Everyone is kicking up. This is what I find, it's not funny, but in some ways it is funny. You've got people going, no, inflation's taken off. When asset prices were rising, it was actually the same thing. It was just the inflation we saw in other areas. So people are complaining the house prices are really high, but no one was stomping their feet about inflation because they went, well, house prices going up that's just house prices going up. That's like a good thing. But when the moment that inflation moved onto the consumer, so at the grocery store, then all of a sudden, oh, this is terrible. Like it's the same thing. If you can't afford a house, you still can't afford a house, right? And that inflation was very real. I mean, we saw those prices, using housing as just one example. We saw those prices more than double over a very short period of time. Like that was monetary inflation in full swing, wasn't it?
Of course, coupled with supply shortages. So that also drove like low interest rate supply shortages, which drove, if you're looking particularly at housing. But if you're going to look at the difference over the last 15 years between monetary inflation and Main Street inflation, if you want to call that, is during COVID, we handed money directly out to each individual person. And that was the main cause. Like we've had monetary inflation for decades, particularly over the last 15 years. And it never reached inflation.
And isn't that the same thing though? Because isn't that just because the money was being handed to financial institutions? So that's why that we saw it happening there.
Yeah. Well, what else are they going to do with it? Like, so I think people are scarred over the last couple of years because of the Main Street inflation. I think is what they're really upset with. They weren't scarred when they were receiving $1,000 checks every week for effectively doing nothing. But
So taking this sort of a step further, do you think that, or not do you think, what happens with this money, right? So if it's effectively being created by the Fed in the situation we're in now, so sort of ignoring that COVID, which was obviously a different situation where they're handing out stimulus checks, but if this money is effectively being created by the Fed and other central banks, what happens to it when they receive it? So they're handing it out to the financial institutions. Is this going to be lent out? So I think the next question is becoming, well, is this good for the economy or not? Because are they going to lend this money out? Does it mean that we'll actually start to see a bit of looser standards, that you'll be able to borrow again and get money for businesses or households who are wanting to, buy property or whatever? How do you read that?
Well, as we know, it's the banks that really create credit for Main Street. So they're expanding the money supply in the real world. I think if that's the question, what are the banks going to do with it? Like, do they put it into assets in one form or the other, or are they going to lend it out? Like, we're entering a period where we expect economic slowdown. Like everyone's been calling for this recession for 12 months, probably longer. So if you're a prudent bank, are you lending that money out to Main Street and taking the risk on a business or a property or a commercial property? Probably not. So they're probably just they're just probably holding on their balance sheet or putting it into short-term bonds, money market funds. So I don't
which
think
exaggerates the problem, doesn't it? If they do that, like,
that's right. It's a vicious cycle.
yep.
Just goes around and around. So I don't see it making its way into the real economy at all. It's probably a good thing at this point. Otherwise, it'd probably exacerbate the inflation story that we've got at the moment. So yeah.
And that's probably an important point. It might not make its way into the real economy of when we really talk about Main Street, but you definitely see it making its way into the financial economy, which
Yep.
is about asset prices. So that's something we're very interested in.
100%. That's what we are focusing on. What we focus on here.
Sure. So why global liquidity? I just want to turn to those charts. So there's two charts in there that really show, particularly the Bitcoin one, a very clear correlation between liquidity and the price of Bitcoin, for example. And gold, probably less clear, but you could also see reasons why that might be less clear, because we obviously had the war in Ukraine starting sort of 12 months ago that sent people into that fear trade where gold served its other purpose. What are you looking at with global liquidity, and why is that the angle that you're sort of focusing on?
It's interesting because last time I was on, we discussing that exact thing where liquidity bottomed around October, November last year, and that was coincidentally the bottom of Bitcoin. And here we are, what, 4 or 5 months later, and where liquidity continues to slowly creep its way up, whether it be from, well, initially the PBOC, a little bit of Japan, and now we're seeing the balance sheet of the Fed rise. And as Bitcoin has become more a more financialized asset, it's certainly the correlation there is starting. It's the correlation of 6 months undeniable, and that's just in the up period. Like as we saw liquidity come down, we also saw Bitcoin drop. So the correlation's longer than 6 months. It's probably since the start of COVID, really. I would say so. Yeah, I think for assets like Bitcoin, which are very sensitive to liquidity, it's using liquidity to measure where we are in the cycle is quite important for where we're going to put our money and where we're going to invest.
And that's my probably follow-up question. Where does that leave us as investors? Do we have a chance to position ourselves if it becomes quite clear and inevitable that we're going to see liquidity continue to come flooding in? And that's my perspective on it. Like looking at everything we've looked at there, it seems inevitable that we get more of it. So how do we position ourselves? Is it only gold and Bitcoin? Does it make sense to be looking at other things as well? What's your take?
And that well, you hit the nail on the head. There's really only one direction it can go. It's liquidity is not going. It may go down for short periods of time, but the trajectory is up because we're coming from such a low base, and there's too many problems to have in the financial system when it's low. So you've got to expect that it's going up. With Bitcoin and gold, I own both personally. But from my perspective, I like to fastest horse in the race, and I think at this point, it's Bitcoin. It's like gold's going to do well as well. There's nothing wrong with holding gold. Like I hold it as well, but proportionally, I hold more Bitcoin as a risk reward bet that I'm willing to take.
So that's sort of, you're looking at that as Bitcoin is probably a little bit further out on the risk curve, but you get rewarded for that additional risk. And in both cases, we expect both of them to go higher purely on the back of increased liquidity in the system. That would be a good summary.
100%. Yep. That's exactly what I'm doing. Yep.
And what do you think about other assets here? Like, do you look broader than that, or is it really just my sort of view on it is they become more complicated because correlation isn't necessarily as clear?
Yeah, that's right. So I don't know, if you're looking in terms of stocks and bonds, like we expect that if rates are going to drop, then bonds will do reasonably well. They will probably do well before stocks do substantially well. If you wanted to go on the risk curve of metals like this, you can always go silver. Like you're looking at the GSR, I think it's around 80 or 85 at the moment. So historically, that's still quite high. You'd expect that to drop and silver to outperform at some point.
So that's almost, I keep referring to that as almost like a leverage trade. So you get the compounded sort of benefit if you believe in this narrative without actually having any leverage, because you're buying, straight up buying the underlying metal. But silver is an interesting one to go further out on that risk curve, isn't it?
Yeah, and it's the same old story. There's no liability by holding your own gold, silver, or Bitcoin. You put your Bitcoin on a ledger, or you get your gold and silver, you put it in a vault, or do whatever it is you do. Whereas we're obviously seeing in the TradFi space at the moment with stocks, bonds, like they're going to do well, but I don't know, it may force people to think more about who's actually custodying their assets, which is why I think we may see more money flow into these self-custody assets over time.
Well, Joe, thanks for all of that. There's so much in there today. Really useful for me, really useful for our audience, I think, to really look at some of these issues. And I like how you sort of ended there that, we're talking about a banking crisis. We're talking about uncertainty and instability in international financial markets. So kind of makes sense that people will go looking for options that are outside of that system. And there isn't that many of them. And you hit the nail on the head. We've got two of them, a Bitcoin and gold that really sit outside of that. So thank you for all of that. I'm sure everyone will appreciate it.
All right. Thanks very much for having me.
Thanks for everyone for watching. Remember, reach out if you have any questions or comments on the social platforms. We'll get back to you as soon as we can on those. That's us for today. Stay safe in the markets, everyone. We'll be watching closely to see what happens tonight in the US market and see if this continues or whether we're in for a bounce or what's going on. But there's certainly plenty to watch all the time at the moment. So we'll be back later in the week and I'll talk to you then.